And now we cross over to our Oh Soo-young for global insights and an in-depth look at important developments in world affairs.
Thanks very much, Morgan. It is indeed time for Global Insight, where we speak to experts from around the world on issues making headlines. The US Federal Reserve on Wednesday signaled that it's likely to start hiking interest rates in March, which would mark the first increase since 2018, and confirmed its plans to end its bond purchases that same month. We discuss how the world's largest economy will handle its monetary policy this year, and for this we connect with Dr. Yang Jung-seok, Professor of Economics at the Catholic University of Korea, welcome, and Dr. Stephen Hansen, Associate Professor of Economics at the Imperial College Business School in London. Very warm welcome to you.
Happy to be here.
Yes, Happy New Year. And, well, let's start with you, Professor Yang. Just hours ago, we got the press release. We heard what came out of this latest FOMC meeting. And, well, how do you think this first meeting of the year sets the tone for what we can really expect to see for the rest of the year?
Okay, well, I think the statement and the press conference afterwards, the Fed did try to give an indication that they will be aggressive in trying to pull down inflation and thus increase the interest rate this year, but they were very careful not to get stuck in a certain time frame, and apparently the stock investors didn't like that too much. But still, the dot chart last year said that there will be probably three increases of 0.25% percentage points this year, but the Fed and the market is opening itself up to possibility of raising it more. But again, there were some questions during the press conference on whether there will be more than 3 or 4 rises this year, and the Fed would not commit to exactly when and how much they will raise the interest rate. They did mention that it will be dependent on data, and also there were some questions on when the quantitative tightening will start and by what method. The Fed did publish a couple of statements on how they were going to do that, but again, they would not be committed to certain time schedule or the methodology. And so the market took this as a uncertainty in the future. And I think depending on raising the rates according to data is eminently reasonable, but I don't think the stock investors are taking it that way.
Yeah, we did hear some very vague words. And Professor Hansen, now, Fed officials, they mostly seem to think that the US economy is approaching full employment and that wage and price increases are becoming more widespread. But as Professor Yang just mentioned, there are also questions as to whether 3 rate hikes are going to be enough this year. How aggressive do you think the Fed's tightening is going to be throughout the year?
So a lot of people have looked at the recent summary of economic projections in order to understand the Fed's thinking around their future policy path. And I think one of the items in the SEP that is often not discussed but should be discussed is the uncertainty and risks around the FOMC's forecasts. So, in theory, all members of the FOMC share an objective function, which is to maintain price stability and maximum employment. So the disagreements that we observe about policy are really driven, in my mind, by disagreements about data and the path of prices and growth going forward this year. And in an environment where those are highly uncertain, we don't know whether there's going to be a Zeta variant of COVID arising. We don't know whether there's going to be war between Ukraine and Russia. All of these things impact on the choices that the Fed has to make this year. And I think rightly there's disagreement about that. And it would be a mistake for the Fed to commit to a particular path. For example, the dot plots now indicate these 3 hikes this year. But I think Chairman Powell has been very clear that those dot plots do not form a commitment. They just form a best guess. And in a highly uncertain world, it's unclear what data will do. And so it's unclear how many hikes we'll need to maintain the Fed's goals.
Well, Professor Yang, as for this week's meeting, it was largely expected to be something of a non-event with no one expecting a January hike. But the focus, of course, was very much on the inevitable shift at the FOMC as the bank is moving into a posture of tightening and hiking rates. Were you expecting the bank to signal that it's ready to start raising its rates from March? Do you think it's the right time?
I think if anything, if they gave an indication, it would be indication that they would not raise the rates in March, and they did not give such an indication. The big difference in statement between this statement and the last statement is that phrase, soon it'll be soon be appropriate to raise the rates. I think that's basically a signal saying that they will raise the rates as quickly as possible, which is in March. I think some market participants wanted more than that, but they did not get it. Another question that I think the market is asking is that will it be 0.25 percentage points or 0.5 percentage points? They did not give an indication on that either. And also they were looking to get some idea on what the quantitative tightening, what the timing and the methodology, whether they will start selling the bonds that the Fed has bought will take place. They did not give an indication on that either. So at least from the Fed's point of view, they were trying to keep as many options open as possible because of the uncertainty. Inflation is the biggest driver behind the Fed's policy right now. If you look at the 12-month figures, inflation is getting worse. But if you look at monthly figures, the inflation seems to be slowing down. So it's really difficult to interpret the data right now. So I think the Fed wants to keep all its options open at the moment.
So indeed, investors were very jitterish all over the world, well, in anticipation and also in reaction to the FOMC meeting. And of course, investors were hoping for perhaps some dovish remarks, but they might have been disappointed. But Professor Hansen, now global markets, they were down last week ahead of the Fed's meeting, and they fell further into negative territory after Mr. Powell's remarks. Why do you think they react so sensitively to these decisions made by the Fed?
Right. Well, I think that there's a generic reason, and that's simply when we think that interest rates are rising, that's going to dampen the ability to borrow and invest. So that sort of applies across the board. And to the extent that investment drives growth, we think that that's going to drag down, the future earnings of firms and thus the stock market. But I think one of the interesting things about the current dynamic is that a lot of people have noted that there's been enormous run-ups in equity markets in the last couple of years during the pandemic. But I think something that's not noted is that the kinds of companies that were growing a lot over the last couple of years are different than the kinds of companies that were maybe growing before. So if we think about airline companies and travel companies, they've suffered a lot in the last couple of years in spite of rising markets. So instead, the companies that have been driving these rising markets are companies that we think do well in pandemics. And those are companies that support remote activities, which tend to be tech companies. They tend to be younger companies, and they tend to be companies that aren't have high cash flow, at least in the short term. So a lot of these companies are really, have a high stock price because there's an expectation that they'll earn a lot of future profits, maybe 2, 3, 4, maybe 10, 15 years down the line. Now, I think two things are happening. One is there's some adjustment in expectations about how permanent some of these shifts to remote activities are going to be. So we saw Netflix, for example, announce that it had many fewer new subscribers this year than it did last year, which maybe suggests that the growth of these companies that did well in the pandemic might not continue as strongly going forward. And so at the same time, these interest rate hikes that the Fed is proposing to undertake also affect these kinds of companies more than other companies, because the discount on their stock price when we raise interest rates is going to be higher when their cash flow is expected to be future oriented. So I think it's the interaction of these two effects, a reassessment of how permanent the shift to remote work and remote activities are going to be, plus the added risk of these particular companies from interest rate rises. And I think that that's generating these aggregate volatility that we've seen in the market in the last couple of weeks.
And well, Professor Yang, how do you think South Korean stocks and the Korean won are going to react to these this expected series of Fed hikes that are expected to come throughout the year?
Well, the Korean stocks have gone up almost as much as the U.S. stocks since the pandemic, and it has gone up significantly more than, say, the European or Japanese markets. And the rise in interest rate for both U.S. and Korea seems to be making the market not only volatile but readjust its expectations and have a significant decline since the beginning of this year. I think that will continue for this year. I think perhaps a little bit different from Professor Hansen. I think major driver of some of the rise in the last couple of years was due to excess liquidity. And when the liquidity is withdrawn, I think it will lower the asset prices of stocks and bitcoins and whatever. And I think we're seeing some beginning of that. I think we will see a very volatile market. Overall, we will see the markets fall in both Korea and the United States. I think the Fed and the Bank of Korea, it's not going to be their major goal, but they want to have as much of a soft landing as possible, which means a slow decline in the market. So I think that's the goal they're going to set as it concerns the stock market and asset markets in general.
And Professor Yang, well, a day after the FOMC meeting, the US's Q4 GDP is expected to be released. And of course, we don't have the figures yet, but we have seen that there was a 1.9% drop in retail sales. Do you think this is an indicator of some bad news?
Well, I'm not sure if you call it a bad news. I tend to think of it as more of a return to normality. A lot of the growth we've seen last year, not only in the stock market, but in the real economy, was driven by very high spending growth in the United States, which was tilted toward goods. I think that was part of the reason why we had supply and transportation bottlenecks, which is one of the major reasons why we have inflation this year. It was driven partially because U.S. had a very high savings rate because of the lot of assistance that they had during 2020 and early 2021, and that is running down. So again, I'm not sure if I would classify this as a bad news, more of a return to normality, but it does mean that the global economy and the U.S. economy, the growth rate may slow down. That means perhaps good news in terms of Korean and international inflation, but bad news for Korean exports.
Oh, Professor Hansen, now inflation, that's been a huge buzzword last year. We just kept hearing about it all around the world. And well, in the US, inflation jumped to its fastest pace in nearly 40 years last month. We saw a 7% spike year on year. Why has it been so difficult to rein in inflation? And do you think Fed officials are going to be able to get these price levels under control as Mr. Biden wishes?
Yeah, so that's a good question. And again, I think it's worth clarifying what the Fed's mandate is. So just to be clear, the Fed is not charged with making sure that there's not high inflation in any particular year, right? So its primary goal is to maintain price stability with maximum employment. And when we think about price stability, we typically mean in the medium run. So say in 2 years' time, as long as we're reassured that inflation is 2%, we'll perceive the Fed as having done its job. And so one answer to the question is that the Fed does not view its job as, taking the 7% inflation realization that we saw recently and targeting the entire, apparatus of its toolbox towards getting inflation down as quickly as possible. Now, what I do think the Fed wants to rein in is the component of inflation that threatens medium-term price stability. And so an argument could be made that part of this inflation is transitory, as was famously, the sort of word of the year in 2021. But I think the Fed started to become more concerned about inflation when part of it sort of broadened out from the immediate supply chain bottlenecks that arose from the opening up of the economy into wage growth, and now we see energy price growth. And when you start to see wage and energy price growth, there's a danger you enter a spiral whereby firms' costs go up, firms' prices go up, and then people start demanding higher wages, and you end up in an inflationary cycle that kind of builds in inflation for the long run. So that's really what the Fed would like to rein in. And the reason it's challenging, I think, one of them, is that we're still not sure why the labor market is behaving as it is. So one, in a typical labor market, when wages start to rise, you would imagine that workers come into the market, but that's not happening, as Chairman Powell has alluded to. So I think it's really that the Fed is trying to worry about, how to make sure that the permanent part of this doesn't end up affecting medium-term price stability.
Well, I'm afraid we're out of time, so this is where we'll have to end the interview today. That was Dr. Yang Jun-seok, Professor of Economics at the Catholic University of Korea, and Dr. Stephen Hansen, Associate Professor of Economics at the Imperial College in London, Imperial College's Business School. Thank you both so much for your time today.
Thank you.
Thank you.